Justin Trudeau is about to make himself public enemy number one once again when it comes to housing, suggesting that there will be major mortgage changes in the federal budget on April 16th. And many are predicting that this change is going to be an extension to amortization, specifically on insured mortgages, increasing the limit for amortization back up to 30 years. Which shows just how out of touch Justin Trudeau is. Because for those of you who remember, this experiment already happened back prior to 2006, and it was a disaster. Not making houses more affordable, but making them increasingly less affordable because, well, that's just how economics works. When you make it easier to borrow money and you reduce the payments, people will borrow more, which puts upward pressure on the housing market and subsequently makes housing prices go up. But before I get on the details and show you exactly how to calculate how these changes may affect you, if you want the most recent Canadian real estate and financial updates, hit the subscribe button and hit the like button so more people like you can see this video. And if, by the way, you're looking down and you're saying, hey, I thought I subscribed to Nolan's channel, but it's not showing as subscribed, well, that's because you probably subscribed to my other channel, which is now more focused on general wealth building and global economic conditions. So if you aren't subscribed to this one already, make sure you hit that subscribe button. Okay, so let's get into it. Let's discuss the latest news on Canadian mortgages and real estate. And again, like I said in the intro, Justin Trudeau is showing once again how out of touch he is with the realities of how economics work. I mean, he's already said in the past that he doesn't really pay attention to monetary policy, and it seems he just doesn't pay attention to what is happening in the real world at all, as he is suggesting there are going to be major changes with respect to mortgages that will make houses more affordable for Canadians, but in reality, he's probably going to make houses a lot less affordable for Canadians, especially if he is doing what is suggested, which is increasing amortizations on insured mortgages back up to 30 years, because this is going to be a recipe for disaster, mostly because it isn't going to change how much people can afford. They're still going to be able to afford the exact same monthly payments, but what it's going to do is increase the amount of mortgage that they can get, which is going to cause housing prices to increase accordingly and subsequently push more houses over that $1 million mark, which will make them uninsurable and subsequently less affordable for Canadians, meaning there's going to be less homes that are worth less than $1 million available for normal people to buy because Justin Trudeau just doesn't get it. And I need to be clear here, this is not a political video. This is purely an economics video, and Trudeau is just showing once again that he doesn't understand basic economics. So let me jump you into the news story here and discuss how exactly this is going to affect you, if in fact this is the rule change that they are going to make. And I want to start by showing you the BNN Bloomberg article. Trudeau says news on mortgages is coming in federal budget. And I'm just going to take you through this article because it's interesting. And it all starts here with, at a news conference on Friday, Trudeau was asked whether his government would extend the limit to 30 years or more, referencing, of course, amortizations, a measure that would ease monthly payments and help some buyers who are currently shut out of the housing market. Now, there's a whole lot wrong with this statement because, yes, this would potentially ease payments if people got the exact same size of mortgage, but more than likely, if they're increasing the potential amortization to 30 years, what that means is that they're also going to allow people to qualify for 30-year mortgages, which is really not making the situation better. And I'll show you in a second, because what that will do is create a scenario where Canadians will, yes, have potentially the same payments, but will owe significantly more money on their mortgages after a 5-year period. Now, apparently, the Prime Minister wouldn't comment directly on that, but he said, on mortgages, we will have more to say between now and the budget date on April 16th, and perhaps we will save it for April 16th. So make sure you stick around to this channel, hit the subscribe, hit the notification bell if you want to see what the latest updates are. Now, there is one part before I go into the numbers and show you how to calculate all of this and how it'll affect you that I have to point out, and it is this quote. Why do we tell a 35-year-old that they have to have their home paid off by the time they're 60? Mike Moffat, a policy director at the Smart Prosperity Institute and a former Trudeau economic advisor, said in an interview with Bloomberg last month. Now, are you freaking kidding me? Why do we tell a 35-year-old that they have to have their home paid off by the time they're 60? Suggesting that a 35-year-old should be able to take significantly longer than that to pay off their home. This is ridiculous. Why are we even suggesting to a 35-year-old that they should have to have a mortgage past the age of 50? Why is it becoming commonplace for people to think that having a mortgage for an extended period of time is a good thing? And I have to say, I'm pretty happy that this guy isn't a Trudeau advisor anymore, because this type of mentality, The type of mentality where people suggest that you should have debt and should have it for a long period of time is gross. It's absolutely disgusting. What we should be teaching people how to do is get out of debt faster so that they don't have a mortgage that they have to worry about when they're retired. And more than that, so that they actually have some time to prepare for retirement by not having mortgage payments prior to turning 65. What an absolute joke this guy is. And this, quite frankly, is the problem with Canada. This is the problem with the way that the government thinks about money and economics and the economy. It's just so bloody ridiculous. And I'm sorry, I don't often get on a high horse here, and I don't often take shots at political parties, but this is so bad. And I want to put in perspective what this will actually do to the housing market, because if this is in fact the change that the government is going to make, what it's going to do is it's going to allow Canadians, some Canadians, probably first-time homebuyers, because that's Trudeau's jam, to purchase properties for about 6 to 7% more than they previously could. And this will have a direct impact on home prices. It is not going to make them more affordable. What it is going to do is it is going to make the interest costs that people have to pay substantially higher, and it is going to make it so that they have to have mortgages for an extended period of time. And wait until you see the numbers on just how much more you'll owe after 5 years if this change were to go into effect. It's mind blowing. So I guess you're probably sitting there going, yeah, come on, Nolan, just show us. So I'm going to show you. Let's take a look at the numbers. So what I've done here is using my calculator that you can get in the description below. You can download it for your computer, you can download it for your phone, you can download it for your tablet, and it has a feature called compare side by side. And that's what we've done in this case is we've created a side-by-side comparison of what a 25-year and a 30-year amortization would look like if that, again, is indeed the rules that are going to be changed. And this calculator is super user-friendly. All you have to do is come into the rate section, click more, change one of the options to 25 years, make sure everything else is the same, and it'll give you a pretty good indication of how this is going to change payments, the interest cost, the amount that you owe, and a bunch of other data. So all you do is plug in your own personal numbers here to see how this might affect you. So in this case, what I've done is I've plugged in the numbers for a $500,000 mortgage at a 5% interest rate. Everything else is pretty much standard here. And let's start by taking a look at the payment. The payment difference between a 25 and a 30-year amortization is $240 per month, which is a pretty significant amount on a $500,000 mortgage. If you want to know what it is for a larger mortgage or smaller mortgage, just come in, plug in your own numbers. And at first glance, this doesn't seem to make a big difference because over a 5-year period, it's only about an $1,897 difference between the amount of interest you would pay on a 25-year amortization and on a 30-year amortization. But that's not the part that really concerns me. The part that really concerns me is this. When you look at the 5-year terms, this is just over 5 years, the amount of principal that you would owe if you were to take a 30-year amortization is going to be $16,000 more. So if the market hasn't gone up, if prices have come down, if you've got a massive insurance premium to the tune of 4 or 5% of the mortgage amount, well, you're pretty much going to be underwater for the first 5 years, meaning that if you need to sell, you won't have that option to sell. And you could find yourself in a foreclosure situation or a bankruptcy situation. And that's what makes these changes so concerning. Is one, it's going to increase home prices. There's no doubt about that. And two, it is going to put home borrowers at substantially higher risk because of how much money they're going to owe early on in the life of their mortgage, which, by the way, is typically the time where people have the most trouble being able to actually afford their mortgage. And let's call a spade here. This isn't going to change behaviors. People aren't going to get a more affordable payment. What they're going to do is they're going to end up borrowing more money. And because they're going to borrow more money, they're going to be more indebted. And it's just going to create a bigger problem than what already exists. And on top of that, we've already been down this road. We know what it'll do. We know that it increases home prices. When Canada went from 25-year amortizations up to 40-year amortizations back in the early 2000s, we saw home prices increase substantially. And this is going to have the exact same effect. And then on top of that, this is going to make the Bank of Canada's job even harder because in order to counteract this, they're probably going to have to increase interest rates further because yes, this will have an inflationary effect, especially when it comes to housing. Again, like I said, to the tune of 6 to 7%, and that just creates more problems. So I cannot emphasize enough that the federal government is just completely out of tune with the realities of the Canadian real estate market, with the realities of basic economics. And as much as I hate to say it, because I'm politically agnostic typically, I really don't care who gets elected. I just deal with the results as I have to deal with them. But in this case, Trudeau's just making Canada worse over and over and over again. Oh, and if you want to see more videos on exactly how he's making the problems worse, make sure you check out this one right here.